Elon Musk's SpaceX has officially crossed the finish line. Under the ticker SPCX, the company is now trading its shares publicly, a move that makes Musk the world's first trillionaire. And this is just the beginning of a much larger wave. If we look at this bar chart, you can clearly see the sheer volume of cash being pulled into the market. SpaceX, alongside upcoming public offerings from Anthropic and OpenAI, are set to collectively raise more money than every other US IPO combined since at least 2022. But the numbers don't look like standard public market debuts. Usually, public investors expect a track record of reliable profits. In this same chart, you can see SpaceX holds a massive $1.75 trillion target valuation, yet it is currently operating at a loss. Wall Street is looking at these figures and asking a very basic question. Does this wave of tech giants going public signal a golden age for the retail investor? Or is it a sign of a massive market distortion starting to unravel? To understand how a company secures a trillion-dollar valuation while losing money on operations, you have to read the S-1 prospectus SpaceX filed with the SEC, and it reads like a science fiction book. Instead of traditional financial forecasts, the company advertises itself as a bet on entirely unproven industries. We are talking about Mars colonization, in-orbit manufacturing, asteroid mining, and the development of human augmentation systems. Meanwhile, back on Earth, the balance sheets tell a much slower story. The AI segment of SpaceX grew just 12.5% year-over-year in a recent quarter. Yet the company hit the market asking for a price-to-sales ratio of over 90 times, a multiplier far beyond what profitable tech giants command. That discrepancy explains why the prospectus leans so heavily on the cosmos. The operational reality of the business today simply cannot justify a multi-trillion-dollar price tag, so the sales pitch has to focus on a highly hypothetical future. It's no secret why these companies are suddenly scrambling for the public markets. The cost of competing in the artificial intelligence race has created a massive money furnace. Building, training, and running these large language models requires a volume of capital that stretches the limits of private venture funding. This area chart maps out the financial reality for OpenAI, but it perfectly illustrates the pressure facing the entire sector. You have annualized revenues hovering around $25 billion. Stacked against that is a projected compute spend of a towering $600 billion by 2030. For SpaceX, the gap between their marketing and their actual product is stark. The company claims in its SEC filing that 93% of its total addressable market comes directly from AI enterprise applications. But practically speaking, Grok AI functions mostly as a novelty extension for the X social platform, with very little traction as a serious enterprise tool. In fact, the most lucrative strategy SpaceX has ever found for its computing power isn't a software product at all. They are simply renting out compute capacity to direct competitors, taking in $1.25 billion a month from Anthropic and $920 million from Google. When expenses run in the hundreds of billions, the private capital pool eventually dries up. These tech firms need a massive, continuous new faucet of money just to keep the lights on and stay competitive. To turn on that new faucet, SpaceX executed a strategy highly unusual for an initial public offering. Rather than heavily courting large institutional banks, they built a structure specifically designed to target everyday retail investors. Looking at this pie chart, you can clearly see the structural shift. In a typical IPO, a company might reserve 5 to 10% of its shares for individual investors. SpaceX blew past that standard by reserving a massive 30% of its initial stock specifically for the retail crowd. To make sure that 30% allocation actually got bought, major brokerages stepped in to widen the gates. Fidelity slashed that capital requirement for retail IPO access, dropping the minimum balance from $500,000 down to a mere $2,000. But the most effective tactic relies on investors who aren't even paying attention. SpaceX reportedly pushed to have its stock fast-tracked into major indices like the NASDAQ 100 within its first 15 days of trading. By securing a spot in those flagship indices, the stock is automatically purchased by the massive funds that passively track them. That means your 401k or your pension could be buying SpaceX stock, regardless of whether you actively chose to invest in it. When large amounts of retail money flow into a newly public company with extreme valuations, analysts start looking closely at who is standing on the other side of the trade. They look for exit liquidity, the mechanism that allows early, private insiders to cash out their shares at the peak of the hype. This timeline shows the immediate threat facing the retail buyer. Right after the IPO, a staggered lockup period expires. Within the next couple of months, nearly $1 billion of insider shares are scheduled to unlock, threatening to flood the open market with sell orders. And the retail buyers absorbing those shares are funding a remarkably unreliable roadmap. A recent analysis found that out of hundreds of ambitious objectives set by Elon Musk over the past couple of decades, only 19% were actually achieved on time. The financial mechanics here are creating a very specific trap. Everyday individuals are buying into a high-risk, unproven vision of the future precisely at the moment the earliest private investors are preparing to sell. All of this is happening in a market with very little structural safety netting left. The S&P 500 is already highly concentrated among a handful of tech companies, and treasury yields are floating near 5%. If those yields rise further, it could easily discourage the appetite for high-risk stock valuations entirely. There is, of course, a more optimistic way to view all of this. You could argue that bringing these tech firms to the public markets early finally gives retail investors access to a generational leap in technology, letting the average person in on the ground floor of an industry that is actively restructuring the economy. As these massive AI firms cross into the public square, the financial stakes couldn't be clearer. We are either witnessing the democratization of a multiplanetary future economy, or the exact moment everyday life savings are tossed into a furnace to keep a trillion-dollar tech bubble inflated.